Debt recycling is one of those strategies that can quietly build wealth over time. But if it's set up incorrectly, it can just as easily make things worse. So in this video, I'll walk you through what it is, how it works, and where people get caught out. This comes up quite a bit in practice, particularly for people who still have a mortgage, but also want to start building investments at the same time. On the surface, it sounds quite appealing. You're not increasing your debt, you're just restructuring it. But the details matter here, because small mistakes in how it's set up can undo the entire strategy. So let's start with the basics. At its core, debt recycling is about changing the type of debt you have. Most people have a home loan. That debt is what we call non-deductible debt, which simply means there's no tax benefit attached to it. You're just paying it down over time. Debt recycling looks at that and says, what if we could gradually convert that into investment debt instead? Because investment debt, when used correctly, may be tax deductible, and that's where the strategy begins. Here's how it works in simple terms. You start with your existing home loan, and you make extra repayments over time, so your loan balance reduces. Then instead of leaving that money sitting there, you reborrow that same amount, but this time the purpose of the loan is different. You use it to invest, typically into something like shares or manage funds that produce income. So what you end up with is this: a smaller home loan and a growing investment loan. Same overall debt level, just structured in a different way. Now this is the part that often gets misunderstood. Debt recycling is not about getting out of debt faster. You're not eliminating debt in the short term, you're changing how that debt is being used. So instead of having debt that does nothing for you, you're aiming to have debt that is linked to an investment. This matters more than it might first appear, because the structure of the debt can influence long-term outcomes. There are a few reasons people use this strategy. The first is tax efficiency. If the loan is used for investing, the interest may be deductible, which can reduce the after-tax costs of holding that debt. The second is timing. Instead of waiting until the mortgage is gone, you're starting to invest earlier. And over long periods, that extra time can make a meaningful difference. The third is structure. It creates a more deliberate approach to how debt is used over time. Rather than just carrying a home loan for decades, you're gradually shifting it into something that has a purpose. Now, all of that sounds quite sensible, and in the right situation, it can be. But the important part most people miss is this: there are real risks here, and they need to be understood properly. The first is cash flow. Even though you're restructuring the debt, you still have the debt. In some cases, repayments can actually increase, which can put pressure on your day-to-day finances. The second is investment risk. You are borrowing to invest. If markets fall, your investment value drops, but the loan remains. And that's not a rare event. That's how markets behave. The third is structure. This is one of the biggest issues I see in practice. If loans are not set up properly, for example, mixing personal and investment use, it can create problems from a tax perspective. And once that happens, it's very difficult to fix. The fourth is behavior. On paper, the strategy looks straightforward. In reality, it requires discipline. You need to keep investing, avoid using borrowed funds for personal spending, and stay consistent, even when markets are volatile. And that's where a lot of strategies fall apart. The fifth is the interest rate environment. When rates are low, the numbers can work quite well. When rates rise, the cost of holding that debt increases, and that can reduce or even remove the benefit. To make this more concrete, think of it like this. You have a $500,000 home loan. Over time, you pay an extra $50,000 off it. Instead of leaving that sitting there, you reborrow that $50,000 and invest it. So now you have a $450,000 home loan and a $50,000 investment loan. Still $500,000 in total, but structured differently. And over time, you repeat that process, gradually shifting more of the debt across into investments. There's one key rule underneath all of this. Borrowed money must be used for investment purposes. If that link is broken, even partially, the strategy does not work as intended. This is general advice only, so it doesn't take into account your personal situation. But in practice, getting that structure right is what really matters. This type of strategy tends to suit people who have a stable income, have consistent surplus cash flow, and are comfortable with investment risk, and above all, are disciplined. It's not something that needs to be rushed into, and it doesn't suit every situation. If you're thinking about this, there are a few practical starting points. First, understand your current loan structure. Is it one loan, or can it be split clearly? Second, look at your cash flow. Do you have consistent surplus income? Third, keep everything separate. Investment borrowing should be clearly identifiable. Fourth, start small. You don't need to implement this at full scale immediately. And finally, get the structure right up front, because fixing it later is much harder. And fifth, get advice. Speak to your accountant or tax professional. So stepping back from all this, debt recycling can be a useful strategy, but it's not a shortcut and it's not risk-free. At its core, it's about being deliberate with how debt is used. Done well, it can support long-term wealth building. Done poorly, it can add complexity without much benefit and end in tears. So the key is not just understanding the idea, but making sure the structure and the discipline behind it are solid. If you want to implement this properly, I help Australians structure this every day. Details are below.